Hello, greetings everyone again. It's been about a month since I've done one of these recordings, and I just wanted to give you a sense of what we're thinking now. We know the market's acting up a bit, unnerving some people. It actually has come a very long way. We've hit record highs, even in the global indices now, the Morgan Stanley All World or MSCI All World Index. So we've come a long way, and we think that this will be that refreshes, just to get to the bottom line there. But we'll get into why we think that after we go through the normal drill here. So we start with fiscal policy, then monetary policy. We'll then go to economic indicators, some market indicators, and then we'll talk about the correction and what we see from here. And as you know, we're very long-term in our focus. Everything we do has a 5-year investment time horizon associated with it, whether it's our research or our portfolio. So we'll talk about the world from that angle in the context of what's going on today. So on fiscal policy, well, I guess Congress couldn't get it together for another relief package. So we do have the executive order in place, which does defer payroll taxes into next year. Now, if the president is to get reelected, I believe he's saying that there will be forgiveness of that deferral, or at least he'll rally Congress to try and get it. And if not, then workers will have to pay double taxes next year, double payroll taxes, in order to make up for this deferral. So it is perhaps bringing some activity into this year that might a little faster than might otherwise have been the case, but it wouldn't be as powerful as forgiveness of payroll taxes, both for employees and employers, for the rest of this year. Nonetheless, it is something. On monetary policy, well, we got some more information from Fed Chairman Powell in the last week or so. And the information was essentially, we're very focused on both employment and inflation. A little more emphasis than perhaps historically on employment, given where we are right now. Still a very high unemployment rate. We'll get into that in a minute too, given today's report. But there was a very interesting nuance he introduced on the inflation side of the equation. We thought he was heading in this direction. Essentially, the policy response is going to be asymmetric. If inflation rises above 2%, and based on the core PCE deflator, which is the inflation metric that the Fed seems to like the best, it now is at 1.3%. But if it were to go above 2%, the Fed essentially would allow it to continue to move above 2% in order to make up for lost time. We've been under 2% for so long. And we're not even sure the measure is correct. If ARC is right, that is overstating inflation, even the 1.3%, given all the deflationary forces at work in the economy. But at least the Fed is saying, if the measure itself crosses 2%, the Fed is not going to react right away. And on the other hand, if it drops below 2%, let's say it goes above 2% and then drops below 2%, it will act right away. So that's what we mean by asymmetric response. So again, the Fed is reassuring the markets that it has their back. You wouldn't know it from this week, but the Fed certainly is willing to err on the side of easing too much. So that's information, and that's important. On the economic indicators, today was an important day. The first Friday of every month usually is. We got the unemployment report. Unemployment dropped back into the single digits. I think most people are very surprised that happened before the election at all. We peaked at 14.7, as it turns out, and we're down to 8.4%. Of course, we were below 3% in January, February, so still high in relation to where we were before, but essentially, well, nearly cut in half, which is a lot of work done in just a few months. Some of the other interesting statistics out of the report, just to underline how strong the economy is and how much of a V-shaped recovery we're in. Household employment was up 3.7 million. Now, household employment is a different metric. Non-farm payroll employment, what the survey measures is what businesses tell them. Household employment is what households tell them. And so it captures more small businesses. And so what I think this is saying is even small businesses are getting back to work. And we know that small business formations, new formations have surged. So what we are seeing is, sure, a lot of bankruptcies and probably a lot more to come. But what these entrepreneurs do is turn around and start all over, especially now that they are being treated more like larger corporations and can declare bankruptcy and get out from under their debts. And I still think that's being underestimated in here in terms of the positive impact that that is having on the economy. The work week also went up. Now, going up 0.1 hour doesn't sound like a lot, but that's the equivalent of, I think it's disproportionate in terms of its impact on economic activity relative to the increase in employment. And what we saw in the manufacturing sector was a 0.3 of an increase, 0.3 of an hour increase in the work week, plus a 0.1 increase in overtime. What this is telling us, reinforcing, is that businesses are scrambling to keep up with demand. They have been way behind the curve. They were behind the curve before the coronavirus, and they were going to have to make up for a lost time, even if the coronavirus had not hit. They became even more conservatively postured during the coronavirus. And now that the consumer is really coming out flying, they're having to scramble to catch up. I don't know if any of you are experiencing this, but when I go to the supermarket, I'm seeing, not in the toilet paper shelves, but in many other shelves, they are not as full as they normally are at my supermarket. It's a little village market. They try to keep everything fully stocked, and they can't. So I do think there's a bit of a scramble here, even for food and so forth. And then I don't have to tell you too much about housing because it's been hitting the headlines recently. On both housing starts and existing home sales, we are seeing increases on a year-over-year basis now. Now, last year was fairly strong. We were well pre-pandemic. Year over year, against those comparisons, existing home sales and housing starts are both up in the mid-20s percent range. And we've seen lumber prices triple. So the raw material costs are going up. We've seen the mortgage rates bottoming out here. And these are two reasons for people who have been thinking about buying a second home or moving from the city into the suburbs and buying a home, for them to act now rather than waiting, because raw material costs are going up fairly substantially. Think about that, a tripling in the lumber costs. And interest rates seem to be bottoming out. They may bounce around the bottom here for a while, but they may not. So jump off the fence now, I guess, would be the message associated with that. Auto sales also have come back a lot more strongly than we anticipated. And these are new auto sales. The reason we are surprised is we saw with the bankruptcy of Hertz, a flood of used cars onto the market. I think Hertz alone was responsible for 700,000 of them. And what I've learned over this pandemic, a statistic I didn't know, and I know a lot of economic statistics, having watched them for more than 40 years. The used car market is 40 million units per year. And what we were seeing was a significant weakness in used car prices, but they came right back. They came right back. Why is that? They came right back, even though there was a flood of cars entering the market, because most people decided during the pandemic that they would not be taking mass transit for some time. And so they decided to buy that second car. So that has bolstered the used car market. And it has also bolstered the new car sales statistics. So new car sales have gone from 8.6 million units at an annual rate to 15.2. And before this, they were steady state, a little north of 17 million. So we are pretty close to where we were before. Now, in our brainstorm today, we talked about auto sales. And if you look at the statistics now, it is clear that total new auto sales peaked in 2017 at 95 million units around the world. And they have started what we believe will be a secular decline. We think they could be cut in half. Maybe not quite half, maybe by 2/3 in the next 10 years as we move towards more ride hailing generally. And as you know, we think Tesla is going to be launching its own ride hailing network soon. And as we move to autonomous. And the reason that's important is because, for the same reason ride hailing itself is important, those cars will be operating 50, 60, 70% of the day without a human driver. And so we will need fewer cars sold because we each are probably going to cut down on the number of cars we have because autonomous will be so much cheaper, actually. And so the market share will go towards them. We use our cars only 5% of the day. And autonomous and even ride hailing is at least 10 times that. And so we'll need fewer cars on the road. And we'll also need fewer parking spaces. I think in the United States, for every car on the road today, there are 5 parking spaces. If autonomous were to become ubiquitous, as we think it will long term, the need for parking spaces will drop dramatically. It will probably be more like 1 for 1 instead of 5 for 1. So that's just an interesting nuance out there. Also on the economic front, we got ISM, the ISM index. So that's for the manufacturing sector in the United States. And we saw it continuing to move up well above 50%, which is the demarcation point between contraction and expansion. But we also got an important number inside of that report. And it's new orders in the ISM index surged to 67.6. We have not seen that high of a number since December of 2003. So even after the 2008-09 rebound, it did not get back there. And that's because the rebound itself after 2008-09 was so halting and full of fear. We also know that inventories liquidated at a record rate in the second quarter. This is a US number, but I wouldn't be surprised if this were true globally. And we've gotten July readings, which showed for all business, meaning manufacturing, wholesale, and retail, another significant liquidation, I think down 1.2% month to month, which would be the equivalent of 12% plus at an annualized rate. That's quite significant. But if you again peel the onion a little further, what you see is the big liquidations were in manufacturing and wholesale. There actually was a 1.2% increase in retail inventories. Now, that's a big increase. And this is because retailers are beginning to replenish their shelves, and they're probably have found some success at it, and so that they won't be pulling at the supply chain as hard as they have recently. So maybe wholesale and manufacturing will catch up pretty quickly as well. And then the other statistic that we have found to be very important as a guide throughout this ordeal is the saving rate. Now, the saving rate peaked in April at 34%. That's record breaking. We've never seen anything like that before. Before the coronavirus, the saving rate was high by historical standards at 8%. I mean, I remember in the 90s, I think, or maybe it was sometime in the 2000s, we were down to nearly zero in the saving rate. And that's usually associated with a high level of consumer confidence. So the consumers, they want that buffer under them, which is good. There's not a lot of speculation. Well, now after, let's see, this would be a July number. The saving rate is down to 17%. 17% is still double where we were in pre-COVID. And what that tells us is two things. One, consumers, having been through this ordeal, might want just a little bit higher of a buffer, but we doubt 17% is that number, maybe 10%. And so what that also suggests is there's pent-up demand still. And we see the pent-up demand more in services, of course, than goods, because we've been able to get goods more easily than access services. So as services do open up little by little, I think that's going to be a nice booster to consumer spending. Services is the largest part of consumer spending. You've got durables, non-durables, and services. Services is the largest part. So important. And then there's another metric that came out this week, consumer net worth in the United States. Consumer net worth is about $124 trillion. Think about that. $124 trillion. Our GDP is about $21 trillion. So GDP is a measure of the goods and services produced in the United States. So that's 21 trillion. And consumer net worth, which is consumer assets. So think stocks, bonds, houses, and other durables that have longer than a 3-year life. Autos would be included in there. Those are separate. I mean, subtracted from those are liabilities, consumer liabilities. So assets are $124 trillion above liabilities. I don't think this metric gets enough notice. We have a lot of strategists worried about debt levels. Now they're worried primarily about debt at the corporate level. And for companies who have been buying back shares with debt, taking on more debt to buy back shares and pay dividends, we think those companies are going to have problems because they probably haven't been spending enough on innovation and reinventing themselves as they should. They've been more catering to what many people call shareholder value. But we're learning from GE and IBM and other companies that a company can cater to shareholders to a degree that ultimately hurts and undermines its potential. And we think that a lot of companies, especially after 08, 09, trying to curry favor with a very skittish stockholders, they were trying to buy back more shares and pay dividends and attract more interest. It's been really interesting to watch the statistics in the equity market as well. Buybacks have been taking equity out of the market, out of the float. And then the other thing that's happened, which is really surprising after how long we had a record-breaking 10-year bull market after 08, 09. And I don't think it was entirely a bull market. I think that it was a very unusual one, lots of caution. But we are now seeing, since the beginning of 2018, a liquidation, net outflows in equities to the tune, it's over 350 billion. And that's adjusted for share repurchases. We're adjusting for that. These are real flows out. Whereas in the bond market, I think we've seen inflows of 675 billion. That's upside down from our point of view. We believe bonds are in a bubble and that equities, and I will get into this in a moment, equities are where more of the action is going to be longer term. And what I mean by that is where more of the positive action is going to be. We think there's very limited action left in bonds to the positive side. And if anything, we'd be worried about a bond market in coming years. Now, on to market indicators. So these are there are a lot of green flags out there for, I'll say, for the equity market. You've got the yield curve positively sloped. Now, that just means that long rates are higher than short rates. So in the treasury market, 10-year treasury bond yields are in the mid 60s, from 0.5%, somewhere around there. And short rates are in the 0.12% range. So that's about a 50 basis point positively sloped yield curve. And many strategists and others think we need a positive yield curve to fuel the market. It's good for financial stocks, and so they are having a bit of a run here. But they just think it means that all systems are go from a monetary policy point of view. And all systems are go. But when we move forward through this cycle, we believe the yield curve is going to flatten and invert again. And it's because of innovation and the deflationary forces associated with innovation on the long end of the curve. And then on the short end of the curve, innovation is associated with very rapid unit growth. So the short end will be more influenced by the unit growth statistics and the long end more by the inflation statistics. Remember, you heard that here first, because we'll say it again. We weren't afraid last year when the yield curve inverted, and we won't be the next time it does. If you look at spreads between junk bond yields and treasuries, you're seeing very tight spreads. There's a lot of willingness to take risk in the bond market. And credit analysts tend to be the most conservative analysts, certainly more than equity analysts. So we often look for a move up in the spread, so that bond investors are demanding much more in order to buy junk bonds than they are for treasuries. That's not where we are. We've had a little bit of a flurry here as the market's gone down, but basically the yield spreads are tight. So that's a green flag. The dollar has been going down. And I would say for some, I don't think the dollar going down is a great thing, because it's a loss of purchasing power here in the United States. But for emerging markets who have which have a lot of debt denominated in dollars, that's a good thing. And so the economic recovery should propagate from the U.S. and from China. China's been going through its own V-shaped recovery into the rest of the world now that the dollar isn't such a burden on them. We've also seen gold. Gold has had a very nice run. It has paused recently, though, even as the dollar has come down. That's unusual. Usually dollar going down is positive for gold. That relationship has broken recently, and so stay tuned. We don't know what that's all about. But other commodities like copper and lumber, they have been extremely strong, and they're still strong. I checked on copper today. It's at levels that we have not seen since 2018. So what do we make about the equity market correction here? Well, a couple of things. The 10% decline for the NASDAQ is a correction. It's not a bear market. And we actually think we needed to see something like this in order to give a lot of investors, especially those on Robinhood and elsewhere, a reality check. Hey, this market doesn't move straight up. And I probably made the mistake of using the word weak holders in our brainstorm today. But I think if an investor is very short term in terms of time horizon, and starts buying just momentum, that's what we call weak holders. When the momentum turns, they're gone. And we, who are longer term holders, do like to see the market tested that way to see how low is low and how much of the recent buying activity is momentum driven. So that's interesting. Then we also know there could be a few more reasons for the market to be destabilized here. One, we are seeing a flare-up in COVID as school starts. I just saw today that Temple has sent students back home. So has one of the SUNY campuses in New York. We saw that at the University of South Carolina, 27% of the students who were tested were positive for COVID. And I think there was another university as well, the University of Alabama, same thing. So, it could be that children at lower levels are going to be sent home from school. And as we know, that's a burden on families where both parents work. So that could be. Another destabilizer here could be fears that we'll end up where we were in 2000. After the election, we won't know who is president until December, sometime in December. That's what happened. And the market was extremely unsettled during that time. Now, there is one big difference. Back then, we were in the middle of the tech and telecom bust. And so this was just another variable to push that market down. I don't think that's where we're going to be. I think we're going to be in a very strong economy, as I've tried to build up here around the time of the election. So I don't think even if we do end up in a situation like that, it will be as damaging to the market. Nonetheless, I'm sure there are some people pulling some chips off the table. And the final thing I'd like to talk about today is valuation. This metric, the PE ratio of the S&P 500 right now, it's at about 26 times on this year's earnings and about 20 to 21 on next year's earnings. Now, we should be looking into next year. The market is a discounting mechanism, but to the extent a correction makes people a little more focused on the short term, they're looking at 26 times this year. And typically, that has been the top of a market when we've hit that mid-20s PE ratio. Now, we believe that if we are right, that the interest rate structure of the market is permanently, I should never say permanently anything, but for the next 5 to 10 years, below 5% at the long end of the curve, say the 10-year. Right now we're at 0.65. We couldn't be further away. But the market has always acted as though 4 to 5% nominal GDP growth is the normalized rate of growth. And in order to do a back of the envelope calculation on what's a reasonable multiple, PE, to pay, you divide 1 over 5 or 1 over 4. So that's 20 to 25 times. And so that's where we've stopped, this idea of a normalized growth rate around 4 to 5 range. If the normalized growth rate, however, is 2 to 3%, because we're in a deflationary world, thanks to the innovations that are sweeping through the world, that are all deflationary in nature. The ones we talk about are 5 platforms: DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technology. As they are sweeping through the world, there's going to be a deflationary undercurrent. Even as unit growth is very rapid. That is highly positive for PE ratios. So if you do the inverse for 2 to 3, what you come up with is of course 33 to 50 times. So we do believe that the multiple structure of the market is rising, and that for those companies with rapid growth and very high margins, which many of these technologies have, the multiples will be surprisingly high. And they are. We've even had to adjust to some of the software as a service 2.0 companies. And we like to see a correction like this, test them. And we are going to be talking a lot more about this in the future. I wanted to come out and talk about it on a day or a week like this week, when it looks like the sky is falling to some investors, especially those who are fairly new to the market. So as you know, we keep a 5-year time horizon. The coronavirus pandemic has accelerated the growth rate and the adoption cycle of all of our innovation platforms, save for 3D printing. 3D printing has been hurt by aerospace and autos, but we think that's going to change as well. And that the acceleration that we're seeing has surprised even the companies themselves. Many of them in the last earnings season and this one are saying, hey, we didn't expect to see this kind of customer coming to us for 3 to 5 years. That's quite something. I believe, when history books are written, that we'll look back at the coronavirus as catapulting us into the new world so much faster than we ever could have dreamed, even ARC. And we are all about 5 to 10 years out. We are surprised. So stay tuned. We think this market shakeout is a good thing, not a bad thing. We need these reality checks. We need to remind, especially younger investors, that the market just doesn't go straight up without a correction. We need these reminders, and so I'll leave you with that and wish you a wonderful Labor Day weekend. Thanks so much.